Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your daily technical analysis of stock index futures. I'll start with UK FTSE futures. A big third bearish black crow yesterday and a more than suitable follow-on lower to the previous session's very interesting combined key reversal down and bearish engulfing pattern right at the top of the market. The market fell down through both the flatlining short medium moving average, currently 74.75, and the flatlining medium moving average, currently 74.29. However, it failed to close below either moving averages, instead closing just over the short medium moving average. This big move down has set up the conditions for a possible weekly key reversal this week. If we close tonight under the 75.27 level or over the 75.81 level, then we'd be on. Anything in between then would have a lesser outside week. Right now we are looking most definitely at a weekly key reversal down here, right on the week, when the market made a new recent high. It's all very interesting. On the way down, the prices approached but shied away from testing the upper trend line, currently 73.92, of what I had labelled a possible descending expanding wedge pattern. That's currently 73.92 to 67.80. Now, as you should know by now, I haven't been entirely happy with this pattern, hence there is a heavy dose of the word possible in front of it, even now. For starters, it hasn't completed the requisite 5 touches combined of both trend lines. Yet leaving that aside for the moment, as well as its short life and steep downward angle, leaving all those aside, we still have this pattern. This led to now three diametrically opposed questions that have been posed. Is it a false break higher? How high will the move be? And is there some other pattern being constructed that may usurp the superiority of this pattern? Okay, so for question one, well, if it was a false break, then we should have known by now. Yesterday I thought that answer was definite no, but today looks a lot different. For question two, well, a primary target X would be in the 78.67 area, with a secondary and much harder to reach target X1 in the 79.46 area. These are big asks of this market, especially from what is in truth a not too good looking descending expanding wedge pattern, and with what has happened yesterday as well. Finally, 3. Is there another pattern? Well, possibly was my answer yesterday, and I expanded on that with the following, and I quote, I have an idea, but I'm not happy sharing it just yet, as I would like to see some more action, end of quote. Yesterday we undoubtedly had more action, and there is a very big pattern that might be in the offing. It is an early March to date large ascending triangle. The flat-ish top side is based on the recent high at 76.45, with the early March to date uptrend currently at 73.04, making up the lower trend line. This trend line is currently below the long moving average, currently 73.16. So far today, a much lower, though not a gapping open, with the market subsequently punching down through the medium moving average and the upper trend line of the possible descending expanding wedge pattern. However, prices have not seemed keen at testing down to the long moving average of the lower trend line or of the larger ascending triangle that are further below as yet. German DAX futures. A third bearish black crow yesterday and a more than suitable follow-on lower yesterday to the previous session's significant key reversal down. Prices set off lower from the declining medium moving average, currently 14.377. This is now resistance, bunching down through the 50% Fibonacci line for 2022 at 14.343, which is also now resistance. Then down through the flatlining short medium moving average, currently at 14.161, only halting at the top of the wide congestion band, 14.079 to 13.804. Prices then pulled back up a little to close just over the short medium moving average. This action now puts at risk the whole idea of the proposed April to May descending expanding wedge pattern, currently 12.530 to 13.813. For the moment, I will still keep the upside targets for this pattern, but I may well retire a whole lot next week. There is a primary target X in the 15440 area and a secondary and harder to get target X1 in the 15725 area. These are big asks. With the recent moves lower, we have the conditions set up for a possible weekly key reversal for this market. If we close tonight over 14450 or under 14444, then we'll be on. Right now we are most definitely looking at a weekly key reversal down. So far today, a significant lower opening, almost a gapping open, and a further move lower, well within the congestion zone 14079 to 13804, reaching down as far as the old neckline, currently 13394, of the December 21 to February 22 head and shoulders top. USE Mini S&P futures. A second bearish Black Crow yesterday and a more than suitable follow-on low to the previous session's bearish double pattern. Prices punched down and closed below the following, the short moving average, currently 4092, which had provided support in recent days. The loose congestion between 3955 to 4055, which has within it the May 21 low at 4029 and a 50% Fibonacci line of the October 20 to January 22 move at 4018. Prices closed below these last two, just below the 50% Fibonacci line. Okay, so that was what happened yesterday, but the bigger picture action is a scenario I've repeatedly described. You see, looking back a bit, with the markets rejecting the overhead resistances of the upper time, currently 41.45, of the January to March bearish shift pitch, bearish Andrews pitchfork, as well as the middle time of the bearish shift pitchfork for the same period earlier this week, we ended up yesterday being in a day 3 of the danger zone of something I've spoken about now for weeks. This is the crossover period of 2 times of the previously mentioned January to March Andrews and shift pitchforks. I had earlier highlighted the previous crossover of times from these 2 pitchforks on Thursday 3 weeks ago as a period where one could expect one or more of the following: volatility, a change in trend, or a reinforcement of an existing trend. This was an important time period, and I highlighted it with a red circle on my daily chart. I'd also drawn another red circle for the next crossover to come from these same pitchforks. This is of the upper time of the bearish Andrews and the middle time of the bearish shift, and it was centered on the 7th of June. Hence I renewed my warning and what to look for. Look for volatility, a change in trend, or a reinforcement of a trend. It seems we had the change in trend situation with some volatility also thrown in as a result. This is what happened these past few days, especially yesterday and maybe also today. So far today, a slightly higher open and a move lower, back below the 50% Fibonacci line at 4018. The next support is at 3989, and then the February 21 high at 3959. Thank you for listening. This short version broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.